In this segment, I'd like to take a much deeper dive into what your role is in each of the 7 exit planning steps. So let's start with step 1, which is on the screen right now. Identifying exit objectives. What is your role in that first step of the process? Well, it's significant. First of all, we need to really be able to quantify what is it the business owner needs for the rest of his or her life. So we call that a financial needs analysis or a retirement needs analysis. It's something you're familiar with. It needs to be done professionally. We don't want the owner to guess at what he or she needs because they're going to be wrong. We've learned that the hard way through too many exit plans. So you're going to have a role in exit planning as the financial advisor. The other thing to consider, and it seems like to me like it's a little bit out of order, but I'll explain why I don't think it is, and that's the need for long-term care insurance. Why would we even talk about it to a business owner at this stage of the planning process? Because the amount of money owners think they need is influenced by their concern over nursing home care and their desire to be at home if that need should arise. So we need to explain, or you need to explain to them, how you can eliminate that concern through long-term care insurance. That then may reduce the amount of money they think they need to have in order to exit the business. So that's why we have long-term care in the very first step. Now, obviously, as you're talking to business owners as part of an exit planning team or as an advisor at this point, you're going to want to use this questioning about their goals and their aspirations and their wants and their fears in terms of leaving their business. We do this in this first stage of the planning process. So the additional opportunity for you is to develop a much deeper relationship with that business owner client, because he or she is going to realize that your concern is about achieving their objectives, not your objectives, their objectives. That's what step 1 is all about. We then need to look at quantifying the resources the owner has to successfully exit their businesses. And again, there's two types of resources. One are the non-business income-producing assets, their retirement plans, maybe the building that they rent to the company, their private investments that you're managing for them. We need to take a look at that and determine at the date they retire how much that's going to be, how much can we expect, what assumptions are we making, what risk profile does the owner want to take, excuse me, and then we also need then to quantify the amount of money the owner is likely to get from the transfer of the ownership interest on a net after-tax basis, and add that to this mix to determine if they're going to have enough money. Well, what is that? That's a financial plan. That is something that you would be involved with doing. You would charge a fee for it typically. That is a role you're going to take in every single exit plan that we do or that you do. It's a critical role. Without really knowing what the owner has and comparing that to what the owner wants or needs, we really can't do an exit plan. We have to know this at the very outset of every planning engagement. And then the other thing we have to look at, which really is a little bit outside of your role, is we need to get a good idea of what that business value is. And for that, you'll turn to other professionals who will be part of your team. After we've looked at what do I want and need and what do I have, usually we have to look at how do we grow business value? How do we protect business value? How do we minimize the taxes when that business value is being transferred? So what is your role as the financial and insurance professional? Well, again, there's a wide number of tools and products and services you can offer in this third step. And I might add, this is on an ongoing basis. This part of the planning process may take 2 years, it may take 10 years. You will be involved in a relationship with the owner during that entire time period. You're going to be looking at things such as, how do I motivate and keep my key people? Well, one way of doing that would be through a non-qualified deferred compensation planning tool That is very commonly used in our approach to exit planning. We want to create a deferred compensation plan that is going to motivate the management team to increase their performance. That's how they become entitled to a deferred award. It's a performance standard. Well, what is your role in that? Usually, at least in our experience, the insurance professional and financial professional is actually involved in the design of this, because you have a lot more familiarity often than the attorney or the CPA, and certainly than the owner. So you would be involved in the design of this, but you would also be funding on an informal basis that non-qualified deferred compensation award. We have seen cases where that deferral is $500,000 a year or more every year. And so it's a significant opportunity. But in smaller cases, it might still be $20,000 to $30,000 to $40,000 of funding a year. That usually takes the form of using a permanent insurance contract that's owned by the corporation, whether it's an S Corp or a C Corp, doesn't really make a difference here. And the accumulation of that money then, when it comes time to pay out the deferred compensation, is borrowed by the company, the cash value is taken out, and it's paid to the owner, or I'm sorry, to the departing employee, and it's deductible to the company. You're all aware of that. Well, why use permanent life insurance? Because that's probably a question the owner is going to ask. Part of the answer is this. I ask the owner, well, what happens if this key person for whom you are creating a deferred compensation plan or some other employee incentive program, what happens if that key person dies and you're within 2 or 3 years of your anticipated exit from the business? Well, what happens is the owner's exit plan dies with that key employee or a group of key employees. That key employee has to stay after the owner leaves if we want to maximize business value. How do we do that? We have a non-qualified deferred compensation plan. It's subject to vesting, so it encourages the key employee to stay after the owner leaves. If the key employee dies, we have to have a lot of money available right away to go out in the marketplace and hire the best key employee in the world to take this key employee's place. Why is that so critical? Because the owner wants to leave. We don't have time, we don't have 5 or 10 years perhaps to train, make sure we've got the right person, and so on, to replace this dearly departed key employee. We have to have a lot of money to go out and hire away the best talent we can find so we can continue the owner's exit plan. So that's a real different twist on the importance of key person insurance for not just replacing the key employee, but allowing the owner's exit to proceed with as little interruption as possible. So we look at things like permanent insurance. We look at things like key person life insurance as well. We also look at another aspect really in step 3 and other steps, which is very often the owner has a real influence in this business beyond just the fact that they're running the business. Very often they're involved with providing personal guarantees and things like that in the business. So as long as we're talking about life insurance in this context, we need to consider key person life insurance on the owner's life. Because if he dies or if she dies, not only are we losing their talent, but we're losing the financial capability of the business. And that's something we find is overlooked all of the time in the business world. And it's a huge opportunity for you to go in and explain to the business owner their importance apart from just running the business. Now, as we look at this 4th step, transferring a business by selling it to an outside third party, the first thing I guess I would think of if I were an insurance or financial professional is, well, what in the heck is my role in a third-party sale process? I'm not a deal attorney. I'm not a business broker. I'm not an investment banker. There's nothing for me to do in this process. And to some extent, that's correct. There isn't a lot for you to do. In fact, in this role, there's the least amount, in many ways, for you to actually do as the insurance or financial professional. What I'd like to emphasize, though, is that this step is the biggest opportunity you've got from a financial perspective in the entire exit planning process. So it's a contradiction. There's not much for you to do. It's a huge opportunity. So what do I mean by that? Well, in another video, we talked about the client who sold his business for $85 million, and the insurance advisor who remained involved, because they were also the exit planning advisor, was there to invest the after-tax proceeds. So that's the liquidity event I'm talking about. In a smaller business, even if an inside sale, there will be millions of dollars that are there to be invested. You need to be part of that process. Ideally as the exit planning advisor, but if not, at least part of an exit planning team, so that when that event occurs, you are there. And I would have to say, I find many business owners become very forgetful about their past professional relationships once they've sold the business and now they've got a pocket full of money. So I can't emphasize enough the need to be there when the pot of gold finally arrives. Many owners would question and be skeptical about their ability to transfer their business to an insider, a key employee, a co-owner, a family member. And the reason for that skepticism is pretty easy to see. These people don't have any money. So how can I possibly, as an owner, sell my business to that insider? Well, we talk a lot about in the exit planning process. As we saw in an earlier presentation, most owners are going to transfer their business to an insider. We have developed a lot of processes and tools to enable that to happen. Well, as that happens, as that process is underway, a variety of different insurance and financial needs start to arise. One, as we're transferring to insiders, we have to be sure if the insiders die, that there's insurance funding in place. We have to be sure if the owner dies, there's insurance funding in place, as there would be in any buy-sell arrangement. Bearing in mind that most businesses are owned by one person, they're not co-owned, part of the inside transfer process is to create partial ownership early on in the business, and so that immediately creates a buy-sell scenario. And it's going to need to be funded for buyout purposes. It's going to need to be funded for key person purposes. It's going to need to be funded if the owner is also the financial resource for the business. So there's a variety of insurance tools to look at. And again, during this time period, there's going to be excess income that is going to be accruing to the benefit of the owner. And from a financial perspective, that needs to be invested wisely so that the ultimate amount of money that we've identified earlier on in the exit planning process is going to be there once this transfer process is completed. The business continuity planning, the first thing you're probably thinking about is, and I understand this, I know all about business continuity planning. We're going to have a buy-sell agreement, and we're going to fund it with life insurance and hopefully disability buyout insurance, and that's business continuity planning. And that is part of business continuity planning. And clearly there are some needs that have to be identified. Why is this important in exit planning? From your perspective as an insurance producer or a financial professional, the reason is this. Once a buy-sell agreement is created, usually that buy-sell agreement is stuck in a drawer right above or right below the business owner's financial plan, and it's never looked at again. In exit planning, business value is critical. We have to know what that is. And so we're going to be adjusting these buy-sell agreements and funding for that adjustment every year. The other aspect I would point out is that most owners don't own the business with anybody else. They're solely owned. So what happens if they die? My question to you would be, what do you do? What do you do right now for your business owner clients who own the business by themselves to protect the family and the business in the event of their death? There are tools available that we talk about. There are tools such as having an agreement with the key people that would allow them to continue the business if the owner dies because their salaries have been guaranteed in the event of the owner's death. Not just their salaries, but also an additional, we call it stay bonus. It's funded by life insurance. So while there may not be a successor owner, we know the business will continue because none of the employees will leave, and that will give us enough time to dispose of the business to a third party or even perhaps to liquidate it over a time period. That's something that's overlooked 95% of the time. We have recommendations for advisors to use so that in every solely owned business, we're providing business continuity for the business. The second thing we do in that, from that perspective, is we have basically a tool available that allows the owner to identify who he wants or she wants to run the business if they die, who should own the business, who should be involved in that decision making, whether it's advisors, whether it's family members, whether it's a friendly competitor, whether it's some key employees. So if the owner dies, there are instructions for the family and the estate of what the owner wants to have happen to his or her business if they die. Combining that with our stay bonus agreement, we now have business continuity for solely owned businesses, and obviously that is going to be funded by insurance and maybe even by disability, buyout insurance or overhead insurance, as the case may be. The final step, in a sense, of exit planning is personal wealth planning and estate planning. Even though it's the final step in exit planning, usually, especially in the case of financial and insurance professionals, usually it's at the very beginning of the exit planning process. Once we know what the owner wants and needs, step one. Once we know what the owner has, step two, we will often talk about estate planning. Because how, for example, this business is going to be owned as we go through the planning process, if we determine it right at the outset, it will lead to perhaps gifting, the creation of trusts, the funding of those trusts, and so on, because exit planning is usually a fairly lengthy process, and we need to be sure that if something happens to the owner, the business will continue and the owner's goals will be achieved regardless of living or dying. So for most financial and insurance professionals, after we've analyzed the first two steps, without which I don't think we can do any planning of any kind, then we're going to look at their estate planning situation. What has to be done today to realize their goals and aspirations if they don't survive? And that, again, is going to be reviewed as we go through the value creation process, the liquidity event, and so on. So just because it's step 7, don't think that we're going to wait to the very end to even discuss this. We're going to be talking about this right away, and there are going to be things for you to do, tools, products, and services for you to become engaged in right away. In fact, perhaps more than the lawyers and the CPAs and others who are involved in this exit planning process. You're going to be involved from the very beginning. We have talked about a lot through these different videos. And what I want to encourage you to think about is this too complicated? Is this too complex? We've got all of these different steps. We've got different advisors involved. We've got owners who are fearful of even beginning the process because they may not know what they're going to do with the rest of their life. Is this something that I really even want to consider? I would suggest this. If you don't have a process that simplifies who is going to do what, when are they going to do it, when are they going to do it in this continuum of time, what is the deadline for them to accomplish what it is they have to do, and we're talking about all of the different advisors involved, it is too complicated. It is too complex. It's too confusing. Owners don't even want to think about it. So when I talk about the exit planning process, I'm talking about the exit planning process for you as an advisor that you will use this as a tool to get the owner from where he or she is today to where they want to be. It is a straightforward process. It doesn't require special knowledge of various tools. It's nice to have exposure to all of those, and I would encourage you to do that. But you don't need to know, for example, the inner workings of a non-qualified deferred compensation plan. You need to know when it would be called for, when it would be a good recommendation, but not how to do it. So a process, because it's systematized, breaks down into small increments each point along the way. Someone's going to be in charge of that process who's going to facilitate and guide everybody else, including the owner. That can be you, or you can just decide to be one of the advisors out there who is brought into the process at the appropriate time. I think the choice is yours. I would suggest this area is the largest opportunity you're going to have probably for the rest of your career. It's going to, I think, really determine